Hey guys, Akil Stokes here, and welcome back to another episode of the Trading Coach Podcast. It's been a while since we've been here on video, but the audio audience, you guys know we've been dropping some pretty amazing episodes. So if you're someone that checks out the YouTube version only, I would highly suggest heading over to your favorite podcasting app and following the Trading Coach Podcast there as well. That way you're not missing out. Now, today I want to do something a little bit different. I want to walk you through a message that I received this morning from a trader that I'm working with who is struggling. And more importantly than struggling, because that's normal in the trading industry, they are becoming increasingly frustrated with their performance. And typically these conversations are done behind closed doors with our Tier 1 members only, but I know that this one in particular will probably hit home for many of you guys, and it also serves as a proper expectation for you guys that are new to trading and who will eventually hit that new trader wall and want to quit and give up and all the stuff that all of us traders go through. Hopefully this provides some insight to keep you motivated so that you can push through that process instead of giving in. So what I want to do is I want to start off by reading you the full email so you can get the full perspective. And then I want to really pick out a few different instances and bring them up and try to make this as short and sweet as possible so it's not an hour-long episode. All right, so here's the message. Dear Akil, hope you're doing well. I don't know where to begin. There are so many thoughts running through my mind, and I don't know how to put them in order or understand what's going wrong. I'll start with the fact that since January 2026, I've been running a demo account where I trade the pairs that proved profitable during backtesting of the BAT pattern from the beginning of the year until today. I am at negative 10%, and I'm wondering whether I made the right choice of pairs, whether I should redo the backtesting of this strategy since I believe I am now more experienced in identifying patterns and generally selecting better setups. So the results might be different. Or perhaps this strategy simply doesn't suit me. I'm attaching the results in an Excel file in case you want to review them. We did that this morning. Secondly, since the beginning of 2025, I've had another account, I'm assuming demo, I'm praying and hoping demo, but it wasn't said, where I've been taking about 360 trades in total, trading both the Cypher and the BAT pattern strategies across 28 pairs. This account is 100K, and from the start of 2025 until about 2 months ago, it had its ups and downs. The lowest point it reached was 82K, which is a negative 18% return on investment, or not return on investment, drawdown, I should say. And until 2 weeks ago, I had brought it back up, to 99.4K. I thought I was fine. I thought that my efforts were finally paying off, but no, right? Between April 7th and April 9th, I lost 9 trades in a row. It's a 2-day period, rough stretch. And it dropped again to 87K. I'm sharing the links to the 10 trades so you can give me their opinion on whether they were valid or not. Again, we reviewed this in our Q&A session this morning. Next part, I often wonder how common this journey is in the life of a wannabe trader. Whether it's normal for the path to be as tough as mine or whether at some point it actually gets better. I'm not sure whether I'm doing what I'm supposed to do or not, or if I need to change something. Whether I should keep taking hits and getting back up until things start working in my favor and achieve a steady upward progress. Instead, these consistent ups and downs that keep setting me back. Or instead of these consistent up and downs that keep setting me back. I feel like I'm trying to reach the surface of the sea and the foot keeps kicking me back down. Maybe I already know the answers you're going to give me because I watch all your recorded live sessions daily and I can hear it in your voice, but I probably need you to remind me to keep going, to give me one more push so I don't give up. Thirdly, I started backtesting the Cypher strategy, and out of the 28 pairs, I already completed 6, and it's going relatively well. However, I would like you to evaluate my trading plan and let me know if you spot any gaps that I should reconsider. Again, we did that this morning as well, and I actually may share with you a snippet of that conversation in our Q&A. So, where to start? Well, let's start with the not giving up part, or more specifically, the journey of a trader. You guys know my story. My story of a trader was very long. It was very hard. And long story short, and hopefully I'm sharing a chart with you, I had to reach rock bottom, my absolutely worst, the moment where I had given up on trading. I had finally waved the white flag. I said, I can't do this, and was filling out resumes to rejoin the job force. I had to do all of that before it finally clicked for me. So I say that because the journey of trading is tough. The journey of anything worth anything in life is tough. You got to take your hits. You got to get your bumps and bruises. There's no such thing as instant success. Success is not that straight line from here to here. Success is that wiggly line where you're going upside down and backwards and throwing up and breaking stuff and all types of learning lessons before you actually reach it. So just to put a realistic perspective of things, what this trader is going through is completely normal. Now, I know the internet over here on this screen doesn't want you to think that. They want you to think it's an overnight success thing where, plug and play and boom, you're successful. But as we spoke about in a previous podcast, right, that's just not the truth. The truth is you got to take your bumps and bruises. Now, one thing specifically that would give me optimism when I heard the part that a trader wrote about, let me see if I can find it real quick, starting with 100K, going down to 82K, bringing myself back up to 99K, so almost back to break even, and then dropping to 87K is this. If we were to look at this as an equity curve, right, we would see that we started here. Hopefully this is going to work out for you guys. We dropped down. That is that 18% drawdown. And then after that drop down, we brought ourselves all the way back up to very, very close to break even. Now, there's two things that are very important about that. One, if you remember the sheet that I showed you that talks about the maximum drawdown recovery. If you remember, each time we go into a drawdown, you have to outperform that drawdown just to get to break even. So I'm looking at the side of my sheet right here. Hopefully it's on the screen for you. I'll just do this. I'll move it in the middle of the screen so I'm not looking away from the camera. But if you take a 5% drawdown, you've got to make 5.3% to get back to break even. If you take a 10% drawdown, you have to make an 11.1% return on investment to get back to break even. If you take a 15% drawdown, you have to make a 17.6% return on investment to get back to break even. And if you take a 20% drawdown, which is pretty much what our trader took, you have to make a 25% return of investment to get back to break even. So although we see this as a negative of like, man, I took a 20% hit, which don't get me wrong, that's rough. You don't want to make that a regular thing. If we just put that negative to the side for a minute and look at the positive is that you actually made a 25% return on investment to drag yourself out of that drawdown. And that is something that most traders don't do. Most traders hit that slippery slide of 20% and they just keep sliding down until they're in the poorhouse. So take that as a positive sign. Now, we can look at the next thing that happened is as a negative sign, right? We went all the way back up to 99%. We almost got our head above water. And then we went back down to 87, which, again, is not great. But if we were visualizing this as an equity curve, right? You went down here, right? You started here, sorry. You dropped down. You came back up, and then you dropped down again. But you have made a higher low. And if you know anything about the market, a higher low is a sign, or one of the signs, you still need to make that higher high, but one of the signs of a bullish trend. So it should be expected that after making a 25% return on investment, there's going to be a little time for relief, right? Those losers have to come. Our numbers tell us that. It's not going to win forever. The key is that we continue to make those lows or keep those lows higher and higher. That way, the next time you make that 25% return on investment, you're going to have your head above water. You're going to be well above that break-even point. You're going to put yourself into profit before that next drawdown comes. And again, the idea there is just to keep it as a higher low. So although this may seem like a negative thing, it may actually be a positive in disguise, where as you're progressing as a trader, you're actually improving. Your equity curve just hasn't hit the level where the common folk sees it as improvement because we're still in the negative. The next thing I would say is this. It is April. which surprised me that it's April already because I swore it was just January. And it also surprises me that it's only April. And it seems like Donald Trump has been president for 15 years with all that has happened since January. But the fact is, it's only April. So we are only 4 months into the trading journey. So in that first statement where the trader said, hey, I've been running a demo since 2026 and I'm down a little bit, there is no realistic expectation that we can have from 4 months of data. I want you to think about it like this. When we do backtesting, right, how much data do we tell you to collect? Well, we tell you to collect 10 years minimum, right? If you're a swing trader or an intraday trader, maybe if you're a day trader, it could be a little bit less, but 10 years minimum. Why? Because it takes that much of a sample size to prove your strategy's number. Think about it from this perspective. If you came into the market and you backtest it for 4 months, 1, how much data would you have? 2, how much would you trust that data? That 4 months could be the best 4 months ever, and now you've got inflated numbers. That 4 months could be a drawdown, and now you got negative numbers. For you guys that have been following me consistently here on YouTube or the videos, I remember earlier in the year coming in, I think it was probably late February, maybe March, and telling you guys, hey guys, Akil Stokes here. Welcome back to another Weekend Trading Edge video. I suck. I'm in a 7% drawdown, right? Because that's how my year started. If you look years past, right, one of my worst drawdowns, same thing. Beginning of the year, I went straight down to like negative 13% for the first 6 months because I just sucked. Rather, I didn't suck, just my strategy just wasn't performing the way it needed to perform. And the market conditions just weren't working with it. And that is something that can certainly happen. The thing is, if you take that, again, small period of time and put it to the side, and you look at the bigger picture, so where I end it and where I will end this year end, I can confidently say that, hopefully I didn't jinx myself there, I'll be in the positive and I will forget all about those first few months because eventually the law of large numbers will take over. The edge will produce what the edge is supposed to produce. So when it comes to the first question about, or the first concern about, man, it's February already, I'm freaking out because this thing isn't working, woosah, right? Give yourself time, right? You need more time before you can place judgment. And you got to stick with it. And this is something that gets so many traders into trouble, again, because when we don't get that instant gratification, when we don't get that instant win, we freak out. I see it with the track and field athletes I coach all the time. I see it with the traders I coach all the time. And this is the main kind of thing that causes the system hopping where, and even our trader said it, hey, if I can find it, I don't know if this strategy is for me. Should I try something different? This is the trader doing all of that work, but then because the first 4 months hasn't gone great, they're giving up. Think about this as the same way a professional coach would handle a new athlete, right? You have this new young athlete, they're 16-year-old, they're playing for a team in red that's potentially bottling their championship hopes because Manchester City is coming, and you're thinking about, hey, how long of a leash should I give this person? If you bring that 16-year-old in right away and they get a little nervy, they take time to adjust to the Premier League, they're probably going to struggle. Do you just sell them right away? Well, maybe if you're Chelsea, yeah. But if you're anyone else, no. You have to give them time to adjust. You have to give them time to develop. This isn't one of those games, going back to trading now, where you just come in and you're good right away. You got to go through your bumps and bruises. This is why I always tell traders, when you start, you are going to be at your absolute worst. Therefore, you should risk the absolute least. Start with a very small account. That way you can manage those bumps and bruises and not blow anything. And then when you progress and you get to the point where you're more experienced and your performance is better, then you can start trading more of what you initially planned to trade. So all that to say that don't give up, right? Hang in there. We had a good conversation about trading plans this morning in the Q&A session, so this is fresh on the mind. But I remember one of the first things, or actually the first thing in my trading plan was a statement. And I read this statement every single day before my trading day started for many, 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 many years. But it said, I believe that the only reason people fail is because they quit before they have the chance to reach success. And I believe in that 100%. So think about that the next time you're struggling. Think about that the next time you're bailing. You put all of that work in. It's only right that you give it time and give yourself time to improve and see it out. If it's the end of the year, then that's a different story. If it's the end of 2 years, we can have a different conversation. But 4 months is not nearly enough time to make any type of judgment about your trading, whether it's going really, really good or really, really bad. Très mal. Now, the final part I want to hit on is this. Our trader said, secondly, since the beginning of 2025, I had another account where I'd taken about 360 trades in total, trading cipher and batch strategies across 28 pairs. And I just want to touch on the 28 pair thing for a few reasons. And this isn't necessarily related to the trader, but for you guys out there as well. As traders, we tend to operate on this belief that more is better, frequency plus edge, frequency times edge equals more profit. Yes, or even more time in the market equals more profit. Yes, it can, but it can also have the opposite effect as well, depending on what your numbers say. But there is a psychological component of this as well. And although it may seem great to trade 28 pairs, it can also be very overwhelming, right? One, from just a pure numbers perspective, before we get to the overwhelming part, when you're testing a strategy, I don't want to say I highly doubt, because I haven't tested every single strategy in the world, nor will I, but if I had to make an assumption, I would assume that one, your strategy isn't going to be profitable on all 28 pairs. Two, even if it is profitable on all 28 pairs, there are going to be levels of profitability that it will reach, meaning that you're going to have some pairs over here that are just a little bit profitable. You're going to have some pairs in the middle that are like, yeah, your steady Freddies, they're okay. They're all right, right? And then you're going to have your big boomers over here, your big boys, where they're super profitable, but they also probably come with sharp drawdowns as well. That's why when we talk about creating a portfolio, we talk about finding a balance, right? You want some of those heavy hitters that are going to give you big returns, but the downside is they give you big drawdowns as well. You want to mix them with some of your steady Freddies who don't really produce too much, but they don't really put you in drawdown either. That way, when those big boys are winning, you can exploit your wins. But when they're losing, your steady Freddies kind of keep that boat afloat and stop you from getting into too big of a drawdown. The point is, we want to be very particular with creating our portfolio. It's no different than creating a business. We just don't want to take everything and do everything, because it's probably not going to be optimal. We want to pick and choose not just the best of the best, but the best mix of pairs. And often the case is that's not going to be 28. You're probably going to be somewhere maybe 5, maybe 10, maybe even 12. But I think when you're trading 28, I think there are going to be some bad pairs in there. So it doesn't surprise me that that's going to have a negative effect on your performance. Now, from a mental perspective, both trading and backtesting, that's going to have an effect as well. So just from an actual trading perspective, and this is from my personal stories, from both a day trader and a swing trader. As a swing trader, early on in my career, I had the same mindset, more is better. So me and my buddy Roy, we used to trade like 20 pairs, right? And we repeated the same mistake over and over again. We would trade 20 pairs, we would get overwhelmed, meaning we'd have trouble analyzing it, because at the beginning of your trading, it takes a long time to analyze something, right? Now I can hop into the charts and boom, 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 bang, and I'm done. Back then it was like, okay, right? It took a very long time. So when you have 20 pairs to look at and things are happening all the time in a 24-hour market, you sometimes rush, you sometimes make mistakes, and that was happening. So me and Roy, we always vowed to trade less. We're like, hey, let's pick like 12 or 10 and stick with that. And then we would do it, and then we'd go back to 20 because we were immature traders, but eventually we stuck with it. So the point is, you can get very overwhelmed. I did the same thing when day trading, but with a lot less. When I day traded, I wanted to look at 8 pairs at the same time. However, when you're down on the 15-minute chart, the 5-minute chart, the tick chart, the range bar charts, and you're in a New York session, everything's wiggling and jiggling because news is coming out, it's very hard to keep eyes on everything. I was looking like this all day. For you guys on the audio version, like I'm moving my head around like I'm on crack or something like that. And I would miss opportunities. Even by teaching in a live room, I still miss opportunities to this day. So what I did was I shrunk my portfolio to just 4, 6 max if it was a particular day, because I knew that's what I can handle mentally, and that would help me eliminate mistakes. And by eliminating mistakes, I didn't make unnecessary losses, which means I kept more of my profit, which meant I made more money, which is the end of the day thing. So from a trading perspective, just think about it like that. I think 28 pairs is a lot. And when I see things like, hey, I brought myself back from negative 18% to pretty much break even, but then in a period of 3 days? No, 2 days, from April 7th to April 9th, I lost 9 trades in a row. I scratched my head. I'm like, when the hell did I ever take 9 trades in 2 days? Like, I probably take about 15 from a swing trading perspective, right? From a day trading perspective, there's been some days like that, right? The market goes wild sometimes. But from a swing trading perspective, I take about 15 trades in an entire month. Like 9 trades in 2 days is entirely, again, I don't want to say too much because it's not my trading, but that's a lot from a swing trading perspective. And what that means is that there's probably some correlated pairs in there, right? There are, because we're trading all 28 pairs, meaning you're probably trading a handful of pairs, maybe 5 or so, that got the same exact signal at the exact same time. And well, if they all won, it would have been really, really good. But if they all lose, it's going to be really, really bad. That's the story of me losing 30K in pretty much a week. Stupid yen tsunami, but lesson learned. So not only is there that, but it also tells me that if you're going to do something like that, and there's going to be that much volatility in your trading where you can take 9 trades in a matter of a couple of days, not only are you trading too much, but you probably want to minimize your risk a little bit as well, because in knowing that you could potentially have all of those trades filled at the same time or similar times, I would guess that maybe at least half of them, if not all of them, were open at the same time. You got a lot of risk on at one moment, and that's just not smart money management. So you want to be smart about the risk management side of that as well. And again, for you guys that want more on risk management, go back a few podcast episodes, go and check that. Now, when we were discussing this morning, one of our traders brought up an interesting point as well about the backtesting of 28 pairs and kind of Now, in discussing this question in our Q&A this morning, I think one of the statements from our trader said that, should they go back and redo their back testing because they feel like their eyes have changed over time? And that's a completely normal thing. And there's nothing wrong with doing that. It's tedious. It can be inconvenient. But if you feel like you're seeing completely different things now than you were back then it may be a good idea to go back and retest just to see, like, maybe you're avoiding a certain type of pattern that you had as valid before, or maybe you're picking up a certain type of pattern that you didn't even recognize before, and see what type of effect that can have on your numbers. But it also brought up a good point, and by also, I mean one of our traders in the Q&A this morning brought up a good point about just when you're backtesting that many pairs, it could have a psychological effect on you as well that you may not even notice. And instead of rehashing that right here, I'm going to share the quick clip of that conversation. That way I don't have to do it again. So Ollie says, real quick, one thing that came to mind, I noticed that the trader is trading all 28 pairs. That's a lot of backtesting, and it's very human thing to a little bit of rush when backtesting. When I first started live trading in 2020, heck of a year to start, I had that issue that my live trading was not according to my backtesting data. Later on, I realized that I had rushed a little bit through my backtesting and didn't go through it bar by bar. Yeah, that's a good point, Ollie. I can tell you that, and it's not to make this a whole backtesting thing, but what I've noticed in my personal experience of backtesting, right? So you guys know how I feel about backtesting. Obviously it's crucial, it's needed. I love backtesting in the very beginning, when I'm all excited and I get to dive into the charts and find things, right? I love it at the very beginning. It's like a new toy. And then I love it at the very end where, like, I'm near completion and I get to crunch the numbers. 'Cause I love crunching numbers. I love getting all the numbers. I love crunching them and making spreadsheets and all that fun stuff, right? It's kind of like similar to a vacation, right? Where it's like you get excited about going, hey guys, we're going to Disneyland. Woohoo! We hop in the car and then you realize, like, man, we got a 20-hour drive. And in the middle, you're like, are we there yet? Are we there yet? When are we there? I gotta pee. I'm hungry. I don't like this song, right? And it's like, oh my gosh, like, how can I throw these kids out the car? Right? That's the middle of backtesting for me. And then when you see that sign, 1 mile to Disneyland, you get excited again. So I say that because what happens is, in the backtesting process, we typically, and this is why it's so important, I've done podcasts on this, but it's so important to kind of like properly plan your backtesting, because in the progress, we start off with all this energy. And we're in there, we're very excited, we're very strict on following what we need to do, we're very detail-oriented during that beginning exciting phase. But eventually, and it could be on the first pair, it could be on pair 10, it certainly happens before you get to pair 28, you hit this period where it just becomes a job. Now, some of you guys are weird and you just love it the whole way through, but for most people, you hit this time where it becomes a job. And you're just going through the motions. And when you go through the motions, you get lazy. Your eyes start, not missing things because you're more worried about how can I get through 10 years of data versus how can I actually find good patterns. You start making up stuff sometime. You start missing things. So that is a real thing that happens. So it just with Ollie's statement, I just want to warn you guys about that. It is certainly real. This is why I would be very organized with how I test, meaning hey, I used to do it like this, where it's I used to plan out pair by pair, where it's hey, I'm going to spend 3 days per pair, depending on what the strategy was, obviously, but in time frame. I'm going to spend 3 days per pair. Day 1, I'm going to test years 1 through 3. Day 2, I'm going to test years 4 through 6. Day 3, I'm going to test years 6 through 10. And then break it up into periods where it's hey, after I'm done, each time I'm done a year, again, depending on how long it takes, I'm going to take an hour break or do something else. That way I ensured that I came in with a fresh mind every time. Now, again, obviously some mechanical systems were easier where I can blow through 5 years because it's a very black and white signal where it's I'm just looking at an indicator. But for a discretionary thing where it actually takes brain work, you got to be very careful about breaking it up. So I hope this was helpful. Again, the idea wasn't to necessarily break down the entire trader's email, but to pick out some points that I thought would be helpful for the general public. If you did think it was helpful, let me know by hitting that like button. And if you have any advice for this trader, feel free to leave it in the comments section below. The Trading Coach podcast is not just a podcast that you come in and listen to 3 times a week. It is a community, a place that we want to help each other. That way we can grow a very nice tribe of traders and hopefully avoid some of the other social media nonsense that is out there. All right. Hope you enjoyed. And until next time, plan your trade your plan. Take care.